What's up everybody, Jaspreet Singh here, and we just got the newest inflation data yesterday, and while it was better than where we were last month we were at 8.5% inflation, now we're at 8.3% CPI, it was worse than what people expected, which is why markets reacted the way they did. We saw a broad sell-off in the stock market after this new inflation data came out, and now pretty much across the board, we are on the verge of entering a bear market in the stock market, and then at the same time in the economy, we're seeing a contraction in the economy where things are slowing down, like especially in the tech space. We're seeing hiring freezes across the board, and we're even starting to see some layoffs. Over the last couple of days, Carvana laid off like 12% of their company, about 2,500 people. Netflix has started some layoffs. So we're starting to see some layoffs on the economic side. So what I want to do today is I want to go over three things. First, I want to go over this new inflation report, what they said, what it is, what to be aware of. Second, I want to talk about the broader economy, things that are happening in the economy that you should be aware of. And third, I want to talk about the stock market because there's a lot of panic, a lot of fear in the stock market. Instead, I want to talk about how you can capitalize on what's going on and things you should be aware of in the stock market. So let's start by talking about number one, this inflation report, because the CPI data came in at 8.3%. Now, the good news that people are saying is this is hopefully the peak because we went from 8.5% last month to now 8.3%. Well, there's a couple things that I want to say. First, at 8.3% inflation, this does not mean that we're seeing deflation. This does not mean that the prices of things are dropping. This means that the price of things are still rising extremely fast, just not at the same rate as they were last month. So at 8.3% inflation, we're still seeing the price of things grow pretty much faster than we've seen in the last 40 years, but it's just not as fast as it was just a month ago. However, this doesn't necessarily mean we're at the peak yet. Back in August of 2021, we saw inflation drop. CPI data dropped in August when it was at 5.3%. And that's when everybody said, oh, now we're seeing CPI drop. It dropped to 5.3%. This means that we're at the peak. Inflation will not pass 5.3%. It won't pass 5.5%. And then it continued to rise after that until 8.5%. So before people conclude that we're at the peak, we have to really just pay attention to what's going on because there are still issues going on in the world, from the Ukraine crisis and then with China, because China has lockdowns in a lot of different places. And these lockdowns are affecting the supply chain here in the United States because a lot of companies are not able to source their products. And if companies are not able to source their products, they have to either sell less stuff or charge more for their products. So we still have the potential for things to continue to rise in price, not to mention that we're still printing money. We're still like in that phase of trying to switch from quantitative loosening, quantitative easing to now quantitative tightening. And on top of that, the United States just passed another $40 billion aid package for Ukraine. Again, we don't have $40 billion. If we did, we wouldn't be $30 trillion in national debt. So that money has to be printed. That's inflationary. So there are things that you want to be aware of when it comes to inflation. And one thing that I want to mention about the CPI report, which I always find so funny, they talk about this thing called the shelter index. So I've talked about some of the reasons why the CPI data isn't the real inflation that most people feel, because the real inflation that most people feel is significantly higher than the CPI data because CPI is kind of massaged. And the shelter index is really just so apparent. It's such a big example of it because the shelter index makes up just under 33% of our CPI data. So it's just about a third of our entire CPI. And what it said was over the last 12 months, the shelter index, which again makes up a third of our CPI data, grew by 5%. What does that mean? Housing costs in general, according to the CPI data, have grown by 5% over the last 12 months. Now, you don't have to be a rocket scientist or an economist or even a random guy on YouTube to know that housing costs have gone up significantly more than 5% over the last year. Just watch any of my recent videos on the housing market where I go over how housing affordability is being affected. On one hand, you have home prices that have grown by around 20% over the last 12 months. That's just home prices. But on the second hand, you also have the cost of borrowing money growing significantly. This is why the monthly payments have gone up more than 50% in many instances than where we were just a year ago. So it's funny, a third of the CPI data is shelter data, and it says that it's only gone up by 5%. So there's the things that you want to be aware of when it comes to the CPI. I'm sorry if you hear the siren in the back. And then the last thing that I want to say regarding this inflation number is, well, it was from an article in Reuters where they had a chief economist come out and say that because this inflation number that we saw is 8.3% and which is lower than last month's at 8.5%, he said, quote, the Fed can stay on plan with the 50 basis point rate hikes in June and July, and there's no reason to move more expeditiously to fight inflation. Essentially, what he's saying is that now this is proof that what the Fed is doing is working. We don't have to worry about inflation. It's already starting to ease, so nothing to worry about. Now, I don't know how much that may be true or not true, but some people's opinion, those are some chief economists' opinions about the Fed working, and it's enough to combat inflation. I guess only time will tell, because obviously I have my own opinions. I think that inflation will continue to be a problem, and it's going to be a big problem because now the economy is starting to slow down and we're starting to see issues in the economy, which brings me to number two, the broader economy. So after the first quarter of this year, 2022, we were hoping, or I guess economists and the Fed and the government were hoping for economic growth, between a 1 and a 1.5% economic growth. What we saw happen in reality was not economic growth. We actually saw economic contraction. We saw the economy actually decrease by around 1%. Now that we're in a point where interest rates are going up, it's becoming more expensive to borrow money. It's becoming more difficult for companies to operate because they need to borrow more expensive dollars. It is going to make it more difficult to operate for some of these businesses, especially if a business was not profitable. Because if a business cannot sustain itself without external dollars, if a business cannot survive without borrowing money or without investment dollars, now it's going to become extremely difficult. And the biggest example of this is the tech sector. Just look at it on the stock market. You can see tech companies across the board just getting hammered. And the reason why is because people do not want to invest their money into these momentum stocks and companies that do not have the ability to sustain themselves through a potential recession and through a potential rate growth market. Because now if it's becoming more expensive to borrow money, you need to be able to justify borrowing money at higher rates. And that means that you're going to need bigger returns. And if you are still in the speculative space where you're trying to figure out how you can generate a profit, well, that's going to become extremely difficult. And so it's becoming harder and harder for some of these bigger tech companies now to raise money. And that means that if you cannot continue to raise money to fund your operations, either you're going to have to start cutting your costs, either you're going to have to start laying off some of your people, or you're going to have to shut your doors. That's one of the downfalls with a rate heightening environment. You can see companies shut down, and the first companies that will shut down will be the companies that do not have the ability to stay in business without their own resources, because now it is becoming more difficult for people to just survive financially. I mean, everything is so much more expensive, so people don't have the ability and the means to spend it the way that they could before, because your gas is more expensive, your housing costs are more expensive, your travel costs are more expensive. So everything is more expensive today than where it was 6 months ago, than where it was a month ago. And it's still growing. Everything is still getting more expensive, way faster than wages, which means people have less money to spend on other things, random things, just leisure things, which means these companies that require or that depend on people spending money are making less money, which hurts the companies. And if they can't get money from somewhere else because interest rates are going up, that can hurt the economy, because then there's less hiring that happens, and you could even see more layoffs. We're already seeing that hiring freeze across the board, especially in the tech sector. So pay attention to that and layoffs as that grows, because if we continue to see more rate hiking, we could see more of that happen. And the third thing that I want to talk about is the stock market. Now, before I go into this, I do want to let you know that if you're looking for an easy way to stay up to date on what's happening in the finance and business world before I can even report on it on the YouTube channel, you got to subscribe to Market Briefs. It is a free financial newsletter that I created where our team breaks down the top finance and business news into a fun, easy to read, entertaining, and witty newsletter. I promise you, you are going to enjoy reading this newsletter. And I can say this because I received so many emails from people saying that this is their favorite email, that they look forward to reading this email. It's the only email that they look forward to reading. It's a super fun, free breakdown of what's happening in the markets. That way you can understand exactly what's going on in 5 minutes or less. So if you want to read Market Briefs and subscribe for free, I'll put the link for you down in the description below. And this brings me to the stock market. So clearly the stock market wasn't a huge fan of the inflation report. That's why when the inflation report came out, we saw a little bump and then it went down. Across the board, we saw a down stock market. We are pretty close to bear market territory across indices. And people have been kind of freaking out because they don't know what's going on in the stock market. Does this mean that we're going to see a bigger stock market crash? There's no way to predict what's going to happen tomorrow. There's no way to predict what's going to happen in a week. There's no way to predict what's going to happen in a month. And what you need to remind yourself is, are you a trader or are you an investor? I am not a trader. I don't try to trade the market. But as an investor, what you want to be aware of is, what are you investing in and what's happening to your investment fundamentally. So what you should be doing is finding good investments, finding good stocks, finding good ETFs. Find the things that you want to invest in. When things get hit hard, when you see these type of red bloodbaths in the market, those are opportunities for you to come in and buy. Now, nobody can predict the bottom. No one knows how much lower it's going to go. No one knows if we're going to see another rally. No one knows what's going to happen. So instead of trying to perfectly time the market, trying to predict the market, there's a couple things that you can do. One is you create a dollar cost average system where every week you just buy a little bit more of the ETFs or stocks that you want to own. So now whether the market's up or down, it's happening on autopilot. Second, you can also create an active method where now when you have your list of companies and stocks and ETFs that you want to own and you see a big pullback, you see a huge sell-off, well, that can be an opportunity for you to come in and buy. And if you see another sell-off where it goes down another 10 or 15%, then you can come in and buy more aggressively. So you want to use down markets as an opportunity to buy, but you want to be buying the right things because, as I talked about with the economy, we can see companies close their doors, and you don't want to be investing into a company that's on the verge of bankruptcy. So this is where you have to be smart and start doing that sort of fundamental analysis. That way you know what it is that you're investing in. But the key here is to understand that, let's just assume, worst case scenario, right? We go into recession, we go into a bad recession. Our stock market's not going to go away. Our American economy is not going to go away. Sure, we can get hurt, but we will recover. We always have. We went through the Great Depression. We went through the 2000 dot-com bubble. We went through the 2008 crash. We went through the 2020 pandemic. And there's a lot of fear. People freak out, but this is where you as an investor want to be smart. You don't want to be panicking. You want to find the good opportunities and use it as an opportunity to buy assets when they are on sale. So this requires you to be calm, but look for opportunities. But the difference here is, do not expect what happened in 2020 to happen again this time. Because in 2020, as soon as the market collapsed, we saw the Fed open up the money printer and then the stock market rallied. So if you bought stocks during the dip in 2020, 6 months later, you had essentially doubled your money. Do not expect that to happen again, because that's not a normal crash. That's not a normal recession. If you are looking for opportunities, understand patience is the key. The way Warren Buffett says it is, the stock market is a place that transfers money from the impatient to the patient. So you have to be patient enough to understand what it is that you're buying and be willing to hold on to these investments until the economy and the markets can turn around. If you enjoyed this video and you want to see my full breakdown of why housing affordability is about to get worse, I made a video covering it and you can watch it by clicking that button right over there. Thank you for watching, and as always, keep hustling. More money isn't the solution to every problem, but it is the solution to a problem where you can't afford something. And this is where you have to understand there's a lot of money in the world,